been another strong week in the markets. In equities, we've seen the S&P 500, the Nasdaq and the Dow Jones all hit record highs yesterday. In the UK, we've got the FTSE 100 at levels that we haven't seen since June of last year, and inching back towards that 7,000 level. And the FTSE 250, the more domestically orientated FTSE 250 index, even that is about 20% above its post-referendum lows. So we've seen strong movements in the equity markets, but arguably the most dramatic moves we've seen this week have been in the government bond markets, and in particular in the UK. We've seen gilt yields hit record lows again, as the Bank of England has commenced its quantitative easing bond buying program. And we've even seen at the shorter dated part of the curve some individual gilts going into negative yield territory. The quantitative easing program has not been running that smoothly for the Bank of England. There have been some stumbling blocks along the way so far. It's struggled to find some willing sellers at the longer end, as pension funds seem to be reluctant to release some of these longer dated bonds. In terms of the yields themselves, we can see that we've seen a strong fall-off in the yields in the UK market. We saw a strong fall-off initially post the referendum result, and this has just accelerated over the last week as the Bank of England has commenced its bond buying program. In terms of the yield curve, you can see how dramatically this has moved post the Brexit vote. Yields have moved down significantly as the curve has what we call bull flattening. So it's bull flattened as longer dated yields have fallen by more than shorter dated yields. So quite a lot has been happening in the financial markets this week. But it's been slightly quieter on the macroeconomic data front. This is often the case in the week following the US employment report. You'll remember last week we spoke about the non-farm payrolls as being a key focus for investors. Well, as it turns out, the data came in a lot stronger than expected. The market was looking for 180,000 new jobs having been added in July. The figure actually came out as being 255,000 new jobs added. So for the second consecutive month, we had a big beat relative to expectations. The last 2 months' data was also upgraded modestly. So that means that over the last 3 months, the average has been about 190,000 jobs added. So now we've had, as you can see from this chart, it's been a long run of positive jobs growth in the US. This is now the 70th consecutive month of jobs growth in the US. However, despite the better than forecasted employment numbers, markets are still not expecting an interest rate increase from the Fed this year. The implied probability of a rate rise this year based on Fed fund futures is still less than 50%. We may get more direction from Janet Yellen at the Jackson Hole conference of central bankers, which is towards the end of the month. As the Fed has retreated from raising interest rates this year, this has helped to keep the US dollar in check, and one of the areas that's benefited from a more stable currency environment has been emerging markets. They've performed well this year after a poor start, generally outperforming the developed markets. And the relatively weaker US dollar has helped with a revival in commodity prices, and this has been beneficial for commodity-producing emerging market economies. But emerging markets are not just about commodities. A key motivation for us to invest in emerging markets is the increased spending power of the emerging consumer. There are a number of emerging economies, such as China and India, which have huge consumer growth potential. Even though emerging markets have performed well this year, as you can see from this chart, over the last 5 years, they've actually underperformed developed markets. We still see some reasonably attractive valuations within emerging markets, particularly when considering the superior long-term growth outlook for certain of these economies compared to some of the major developed markets. On a price-to-book ratio, for example, you've got the MSCI World Index, which includes developed markets and not emerging markets. That's trading at about 2.2 times price to book, with the MSCI Emerging Market Index is on about 1.6 times. Also, we've seen the share prices of some of the listed investment companies within the emerging market sector lagging their underlying NAV returns year to date, which has caused discounts to widen to some more attractive levels. Our fund research team have a number of funds on their list for exposure to, gaining exposure to emerging markets. So please do speak to your brokers for those recommendations. In terms of corporate news flow this week, this coming week, it's much quieter as the Q2 reporting season begins to wind down. Our focus this week for us will be on BHP Billiton on Monday, and then on Tuesday we've got Home Depot. Home Depot, which is the leading North American home improvement retailer. And the focus in the Q2 numbers here is going to be on the same store sales growth, which were ahead of expectations in the first quarter, causing guidance to be raised. So if we have another strong number here, then we could see the company raising its guidance for the full year. Thank you.